Good afternoon, everyone. I'm Kristen Lucas, Managing Director and Chief Marketing Officer, reporting in on behalf of Emily Drake, live from Cleveland, where it's, I think, a balmy 20 degrees today. Much better than earlier this week's -11. So we're welcoming clients not only from our Cleveland office, but Buffalo Grove in Illinois, Harrisburg, Pennsylvania, Buffalo, New York, Princeton, and Cherry Hill, New Jersey. As always, it's our pleasure to serve and inspire you and your families. So based on attendance and replay statistics and your feedback, this is the last investment town hall that we will be doing live this year. Going forward, we will record them and share them as videos because usually we have more attendees. We have less attendees live and more attendees watching the replay. So we're going to try that next quarter. Watch your emails for more information on that update. The goal of the town hall is to connect you directly with John Silvas, our Chief Investment Officer. And like I said, we will continue that on a quarterly basis. He'll recap where we've been, his thoughts on where we are today, and what the year ahead might bring. We asked for your questions in advance, and John and his team had prepared slides addressing those and other frequently asked questions. Be assured that your advisors are in continuous contact with the investment team. John and his team do a good job on updating us via video and email constantly. Here's some ways that you can be too. You should be receiving Fairport perspectives via email. So this year you would have received John's themes, I think on the third day of the year. If you're interested in even more information and weekly updates, you can ask your advisor and they can share a weekly Fairport market note with you. You can also follow the hashtag Investing with Fairport on LinkedIn and Facebook for frequent thoughts on the markets and economy. So housekeeping today, you're muted on this webinar. We're unable to see your faces, but if you have questions during the webinar, type them in to the chat window and I'll be able to see those and we'll answer as many as we can, time permitting. So with that, I'm going to turn it over to John, my favorite Chief Investment Officer.
Well, thank you, Kristen. I appreciate that. It's been a big week, you know. The Buckeyes won the national championship on, I think it was Monday night, right? And at least I know you went through all the offices. So for the Ohio people, the NFL season ended pretty quickly, but we do have the Buckeyes and they did win the national championship. So we're excited about that. But for our other offices in Buffalo and obviously in Philadelphia, good luck this weekend. I hope everybody does well. I'm an Eagles fan when I'm not a Steelers fan, so I'm rooting for the Eagles. See how it goes. Always exciting time of the year. So 2024, you know, in case you haven't noticed, we had an election during 2024. We had an inauguration this week on top of the national championship. You know, the question is, are things going to be different this time? And I put a question mark on there. This is a picture for anybody who spends too much time on TikTok or Reels like I do, of an AI meme of President and Elon Musk dancing. So I'm not sure what AI is really good for, but as far as memes, it's really, really good. So we'll see how it goes. As I said many a times, we try not to put too much focus on politics when we look at the markets. It's more the economy and earnings, but we did go through a major event here over the last few weeks, and so far everything's fine. So we'll take that as a win. So the last quarter, the fourth quarter of 2024, which really wraps up the year, equities had another solid year. There's really just no way around it. They were up, as you can see, all the way to the far right side there, the column. Large caps were up about 25% for the year. That's including dividends. And then the small caps were up about 11.5%, still a very good year. And the MSCI All World Equity Index, which is something we use as a benchmark, that as a global equity benchmark, was up just around 17.5%. I did a little rounding there. Bonds are still having a hard time. 2024, they were slightly positive, but if you can see on that column on the far right, all the way to the bottom, they're about 1.3%, and they've struggled over the last 5 years, really returning very minimal gain, if any. I think the one thing, if you look at this chart, especially again, I'll focus on 24, but you can go back the last 2 or 3 years, is cash was up 5%. We were up 5.1% in 23. And I think we'll continue to see that start to decline as we go forward, as rates start to fall, especially on the short end of the curve, which is the Fed funds rates and your money markets and your savings accounts. You'll see that start to fall. So I think the period of 5% plus on money markets is probably has come to an end. So it's it's the best consecutive years we've had since 1997 and 1998, and I try to bracket them together, as you can see in the chart. Historically speaking, when you have good years like this, they tend to come in bunches. So we could be in line for another good year this year. I have a chart later on. I'll show you some historical standards there. But again, the S&P climbed 25% for the year. We had over 57 record closes, as you can see there. And overall, the economy remains healthy. The two things that we looked at most in 2024 were concerned by was direction of interest rates, and the Fed did start to cut rates, so that's a positive. And then inflation, although it's been sticky and not a smooth transition, the trend is lower, and we'll talk a little bit about that as well. So far, we're off to a good start. As far as the bull market we're currently in, it started in October of 22. We hit the 2-year mark in October of last year, 24. And as you can see, that solid red line down there, it gets a little muddled down there, but usually if a bull market gets past 2 years, which we have, then the minimum you'll see is about 5 years. So as you can look, again, it's a little complicated there, but 1987 and then in October of 07, we saw bull markets last 5 years, and those have been the smaller of the group. So I think it's a good chance we'll continue to see positive growth this year. I think it's going to be a little lumpier than we have seen in the past. And I'll talk a little bit about that as well. As far as the makeup of Congress, I know, again, we get calls from clients either excited about the election or very upset about the election. Some people fall somewhere in between. But bigger picture, I don't think it has a lot of control over the direction of the markets. It's really the direction of the economy. But as you look here, I got a square, red square around, or I guess that's technically a rectangle, around where we're at today. So we have a Republican Congress and a Republican president. So both the Congress and the White House are controlled by one party, historically speaking, and there's not a lot of data points here. It's about a 13% return. Where we might go in the not too distant future, and I'm making a guess here, and it's a way too early prediction, is the odds-on favorite is that the Democrats probably regain control of the House. Historically speaking, presidents tend to lose House seats in the midterm, so there's only a three-seat majority, I believe. So that's likely to happen. So even then, if we move to a Republican Senate, the Democratic House, and a Republican president in 2026, is still a pretty good return. So don't put too much emphasis on who's in the White House or who has the gavel as far as the speaker and those things go. So I'll stop there. Real quickly, we'll talk about the economy and kind of get into where we're heading. But any questions, Kristen, out there?
I have some questions, but they're more market and portfolio related. So,
okay. So
let's go ahead with this economic section.
Okay, great. So I think, as I said earlier, I think the two things that most people were concerned about last year, and we were, as an investment team, were interest rates and the direction of them, really monetary policy, I should say, by the Fed, and then how inflation would be handled. And so far they've both headed in the right direction, and that's been a positive for the economy. So as we look out to 2025, we have a couple themes that we're focusing on. While we had 3% GDP growth most of last year, I'm sure we'll see some type of growth scare out there. I don't think we'll see a recession. There's a lot of things on the horizon, which I will talk about in a few minutes here. Inflation, I think, is proven, as I already mentioned, to be a 2024 story. It's not going to be a straight line. The trend always looks a little choppy, but I think we are seeing the direction of inflation going down. And when I say going down, it's important to point out that it's growing at a slower rate. Inflation or prices tend not to go down; they just don't grow as fast. So if we were growing at 10% and then 5%, now we're growing somewhere around 3% or less. The other one is the Fed's, I think, will probably cut rates more than 2 times the forecast they had at the end of the year. It's important to point out the Fed does a lot of great things, but forecasting is not their expertise. They are probably one of the worst forecasters. If you go back to this time last year, so at the beginning of 2024, I think the Fed was predicting 6 rate cuts, and I think we had 3. So again, not their forte, but we'll see how it plays out as the year goes on. And then finally, the tax burden for most people, if not all Americans, is likely to stay the same, if not go down. We'll see how the Congress and the president work together to get the extension of the 2017 tax cuts extended. And I think the other thing is, we're going to see tariffs go up. How much and where and what countries are affected, I think those things are all still in play, and it's probably way too early to figure that out. But I do think we'll see that in the coming months.
I do have a quick question
Yeah,
to your last point. Klein asked, how will the tax burden go down?
Well, I think if you look at the current status, so really they're trying to extend the current 2027 or 2017 tax act. If we don't extend it by the end of the year, they revert back to the previous levels, which means everybody or almost everybody would see a tax increase, either through personal rates or the deductions. They raised deductions. I think the child tax credit was also raised. I don't have any kids that get benefit from that anymore, but so those things would all be repealed or would sunset. So that's number one. So at the very least, if they extend it, your taxes are pretty much going to stay where they're at for, again, the vast majority. There's going to be some exceptions to that rule. Where they can go down is, again, it depends on how much the president fulfills some of the promises he made during the election. He talked about the tips. If you get tips, they're going to be tax free. How that will happen, I don't know. He mentioned about Social Security taxes potentially being not taxed anymore going forward. So that obviously would hit a lot of the people that receive Social Security payments. They talked about, that's one other one that he mentions many times, that's skipping my mind. But those are a couple of examples of how they would go down. I think at the most, it's more that the other one was a SALT tax. They're talking about maybe extending that from a $10,000 exemption to a $15,000 exemption or somewhere in between. I'm sure that'll be a bargaining chip as we move forward. So I think those are some of the examples. How it all plays out, it's the old saying about watching the sausage be made. So I'm sure it's going to be an ugly process, but I think at the very least, for the vast majority of Americans, your taxes likely won't go up at all. They'll probably stay the same. And I think for many, you'll see some of those deductions kick in or changes. Yeah, no problem. So like I mentioned, the economy remains pretty strong. We ended the year 2024. We're going to get the fourth quarter GDP numbers here, I think, next week. But currently, the Atlanta Fed, who's been pretty good at predicting or using their econometric model, is predicting about a 3% GDP growth on a quarterly basis annualized. And I think that's where a lot of people are starting to fall, somewhere between 2.5% and 3%. And it seems like it's going to continue as we go into 2025. So far, we saw pretty robust retail sales at the end of the year for the holiday season. That tends to be a good indicator that we finished the year on a strong note, and that should carry forward. Usually stock markets go up, people's confidence goes up, consumer confidence goes up, and they tend to spend more during Christmas. And I think we saw that play out this year. Job creation continues to be fueled by what I think are animal spirits. We're starting to see that pick back up. The November, December job numbers, job creation numbers, we're back above that 250,000 mark. there's been a lot talked about animal spirits and really what
Yes, can you please talk to that?
yeah. I probably should have Googled it on Investopedia to give everybody the official terms, but it's basically where people you see a rise in consumer sentiment, you see a rise in CEO sentiment, and people are willing to do more because they have more confidence in the outcome going forward. A good example of that would be recently, I think it was the December number, so this is a right after the election, but the CEO confidence numbers, meaning they asked uh, CEOs of major companies, how confident they are about their business going forward, uh, went up quite a bit. And mainly that's probably driven by the promise. And again, they're still just promises at this point, although there was a couple executive orders already signed, actually not a couple, hundreds, of a deregulation out there. And again, trying to uh, smooth the process of business, meaning taking some of the roadblocks out of the way. So that's kind of what we mean when we talk about that. Less regulations. Believe it or not, if you put tariffs in place, a lot of times that helps domestic companies versus the ones that import. So there's that involved. Lower interest rates, which would help in the cost of financing going forward. So that's kind of what I mean when I say that.
So it's not animal ghosts.
Yeah, no animal should be harmed in the process is my hope. I'm pretty sure that's the case, but we'll see. Uh, again, credit markets, another indicator for the economy, remains pretty solid. As you can see in that lower right corner with the little gray circle, corporate credit spreads are still pretty tight. I think, there's a lot of reasons for that. One is, again, you have a pretty robust economy out there. Jobs are still pretty plentiful, and there's much more options in the financing for companies to get financed than there used to be before. So still a pretty good indicator. I would call that kind of a leading indicator. If that starts to go up, that usually signals a concern that maybe we're seeing a little softness in the economy, and so far we just haven't seen it. So, and then we talked a little bit about the inflation already, but it's been a little choppy. It's not going to go down perfectly, but we do think it's going to trend back towards that 2%. Likely won't see that this year. We may not even see it next year, but we started off at 7-8%. I think we got as high as maybe 9 at one point. This is core CPI, so it came in December at 3.2%. And actually wrote them down here. The headline number was 2.9, so we're below that 3% threshold for headline, which includes energy and food. And we think that'll go down as we go forward. One of the biggest components, and this gets a little wonky, but one of the biggest components within the CPI number is shelter, so rent, owner's equivalent rent, and that's been a little sticky, but it's starting to come down, and it's one of the bigger components, so that should be a tailwind going forward. And then, finally, as far as the economy goes, I think, interest rates are kind of what greases things, financing, and the 10-year looks like it's starting to roll over. The 10-year Treasury yield, we got up to 480, I think it was. That 5% level is kind of the scary spot. I think we really want to see it stay below 5. If we can get below that 450, and I think it was 462 today, if I'm not mistaken, we're starting to see it come back down. That's a positive. As anybody's bought a house in the last couple of years, mortgage rates tend to be tied to the 10-year. So as the 10-year rates come down, mortgage rates tend to follow. As they go up, we get back around that 7% level, which I know psychologically seems to be a spot people don't want to get to. So that's kind of the economy. We can move on to the markets. If you want to ask the questions now, we can, or we can hit them as we go.
So I have a lot of medical related questions about big pharma, AI company that's working on blood work cancer identity.
Well, I'll try my best on those. I don't know every company, and I certainly don't know every cutting technology out there. But
and then I'm sure you're going to touch on crypto, digital, and Bitcoin at some time.
I can. I don't have a slide out there, but I can do that. So let me start going through it, and if you want to throw them in at me as we go, we
Sure.
can do that.
Yep.
I'll touch on crypto. It's not an asset class that we tend to buy for clients, or we even really spend a lot of time on. President Trump, who during his campaign was kind of embracing the crypto culture, I guess it is, and I think we're going to see more about it. His appointment hasn't been confirmed yet for the SEC. Is a little more pro crypto, pro digital currencies than its predecessor, which was Gary Gensler. So I think we're going to see some changes there. How that affects everybody going forward in the short term, I'm not really sure. It's not really considered an asset class for most people at this point. I don't think it's going away. I think at some point you could see that Larry Fink, who is the chair or the CEO of BlackRock, spoke yesterday in Davos, Switzerland, about cryptocurrency, and he said if every institution or endowment had 2% in their portfolio, it would drive the prices substantially higher. So we'll see how it plays out. I think this administration is much more friendly to the crypto assets, so I think we'll see some changes in regulation, but it's not something we currently recommend. There's a lot of compliance issues to it, but if it's something you're interested in and you wanted to speak to your advisor, that's fine. We can go from there.
Sector related questions. Would you like me to ask those now?
Give me like 2 seconds.
Perfect.
I'm going to get to that in the portfolio portion, but we can talk about that. So market themes for the year. And again, some of these, the risk of doing these is they get stale pretty quickly because things change all the time. But I would classify the year as we've done 2 steps forward, which is we have 2 years of 20% or more. Haven't had a correction, and I'll talk about that in a second, in a while. So I think we'll probably see a stumble at some point in a correction of 10%, which historically speaking is pretty normal. I don't think it would stop us from seeing positive gains this year. Just that I think at some point there's going to be a stumble in the markets. I could go down a list of things, but as we get throughout the year and we get through the honeymoon period of the new administration over the next few months, a month or two, we have the debt ceiling to deal with, which is hanging out there. We have the budget to pass, which is hanging out there. The speed of which the Fed cuts rates seems to change on a monthly basis as they have meetings, so that will spook the markets at times. And then obviously we have the issue with tariffs and how much will be implemented. I think President Trump mentioned February 1st as announcing some type of tariff on Canada and Mexico. There's an old saying that you take him seriously, but you don't take him literally. So I don't know if February 1st is really going to be the day or he just threw that out. But anyway, I think we're going to see that. So I think there's a lot of reasons where the market can, have a little bit of a hiccup, but I still think the fundamentals look pretty good. Tech sector, we'll talk about this when we get to the portfolio segment. I think it probably gives up market leadership. I don't think it's going to underperform the market necessarily, but it may not be the best performing sector. I still think cyclicals will outperform defensives, and we define that as discretionary names, tech names, and industrials. That's kind of how we define cyclicals. Small caps finished the year pretty well. I think they're going to continue going forward. Private investments has been a big topic. We get a lot of requests, and we've been talking to clients quite a bit on that. I think that demand will remain robust, but I think the more important thing is you want to be selective, and we have some opportunities where we can help you do that. And then artificial intelligence, I think, as I said before, and I think I mentioned last year, is still in the early innings. We're not even at the midway point, and I think we're entering this transformative era of technology, which means we're going from the hypothetical to the reality of it. And I think, was it the day after the inauguration there was a meeting in the White House by a few different tech leaders, and they're going to spend $1 trillion again. A number of it could change on building out this company called Stargate, which is going to create data centers all over the country. So big deal. We'll see how that plays out as we go forward. Valuations remain stretched. We ended the year at 21.5 times earnings, priced earnings. We've kind of been bouncing around that area for a while. I think we probably have peaked there at 21.5 times. I think most of the returns this year will be driven by earnings and not by multiples. But I mentioned this at the beginning of last year, so I'll bring it back up again. The last 2 times that we got above 20 times earnings, the market stayed there for about 700 days. So it's about 2 years. We're just under 250 days. So we're not even halfway at that point yet. And returns were about 45%. We've seen about 20% from that point. So I agree that they're high, but historically speaking, they tend to stay high for a while before they start to come down. So we're probably in that sideways movement, but I do think 21.5 times is probably going to be the peak there. And I mentioned this earlier about 20% gains in consecutive years, but market strength, tends to remain, tends to be a tailwind for equities. As you can see on this chart, or table, I should say, I guess. No chart. Solid returns are normal after 20% gains, especially if you have back-to-back years. So if you go over to that blue column on the far right, after back-to-back gains, historically speaking, and it's only happened 4 times, so not a ton of data points over the last 75 years. But when it's happened, the returns in year 3 have been positive 100% of the time, and they average about 20%. So again, when you tend to have the wind at your back, it tends to continue as you move forward. So all things being equal, we should be set up for a positive year this year. We did talk about corrections and the budget deficit, or the budget, the deficit, the debt ceiling, tariffs, all those things could play a hand in it. Misstep by the Fed, anything like that. But we've gone 280 days without a 10% correction, and it's hard to see in that upper left box. But in secular bull markets, it's about 330 days. For all periods, it's about 172 days. So we're in that range where we could see a correction. Wouldn't be historically uncommon at this point. And I think we'll, not predicting a recession. I'm sorry, I'm not predicting a correction, but we're in that zone. And historically speaking, in a bull market, they tend to be areas where you shake out some investors, and they tend to be really good opportunities to reposition your portfolio. And that's kind of how we would approach it this year if that happens.
To that regard, I like this question. Does the expected stumble and 10% correction keep you up at night?
No, I think it's really the environment it happens, and I'm assuming that where we're at today continues throughout the year, where we're going to see better than trend growth, which is somewhere above 2%. In inflation at least staying or trending lower, and I think it'll trend lower, but I think that 2.5 to 3% range is probably where we're going to get. It's going to be sticky for a while, and I think that's fine. And then, if the Fed continues on a rate cutting path, and it doesn't really matter how fast they do it, it could be once, twice, 3 times this year, but the fact that they're not raising rates, and they are biased to the downside, not the upside, tends to be a positive environment as well. So in that environment, I'm not too concerned by it. And, we'll see how it goes from there. But no, the answer is it wouldn't keep me up at night. A lot of things do, but that one wouldn't be one of them. So, market cycle clock, I won't spend too much time. It's just another indicator that points to better returns going forward. Again, when you're in a declining inflationary environment, and believe it or not, we are in one, and growth remains positive, you tend to be in that lower left corner, and that tends to be good for markets. Oops, got the wrong title there. Anyway, a presidential cycle, as you can see, there are four areas there. It's a little confusing because the fourth one is the year we just finished, 2024. So that was the election year. And if you can see my cursor, we had a pretty good year, and that historically is the way it works. And then as we go into the first year of the cycle, which is the post-election year, which is 2025, you tend to see a pretty good run, and then you do see some softness, call it through the fall, September, and then into the second year, which would be next year, 2026. And that pattern's held up pretty consistently over the years. So I wouldn't be surprised if, again, we see some softness at some point this year, but still have a positive year. And then, as we always talk about, post midterm elections, you tend to have this great run, and that's been fairly consistent too. We're not anywhere near that yet, but trust me, we're going to blink and we're going to be there before you know it. I already see people announcing they're running for governor for 2026 and stuff, so it's coming. We may not like it, but that's just the way it goes. And then finally, as far as earnings go, I mentioned a couple minutes ago that I think earnings will drive performance more than multiples this year, and we're seeing right now, this is from Goldman Sachs, their estimates, but they're forecasting about a 13% earnings growth going over all of 2025. Those numbers tend to move back and forth, but they tend to go up, as you can see. Over the last couple of years, over the last 3 quarters of last year, the estimates always were under where it actually came in. Doesn't always have to happen that way, but technically in a expanding economy, you see that. So we're in the early parts of fourth quarter earnings reports, and so far they're pretty good. And we're gonna have a lot of the tech companies come up next week, but we're predicting, or Goldman Sachs is predicting 8% and about 13% next year. And I think that's probably in line with what we'll see. And then, again, talking about the environment you're in, we're in a falling rate environment, as I mentioned a couple minutes ago. And as you can see by that gray line there, go to the far left, bonds tend to do well in a falling rate environment, as do stocks at 13%. So, if I had to pick my poison, I'll take lower rates, or rates going lower than rates going higher. And I think that's the environment we're going to stay in for if not all of 2025, maybe even into 2026. So I'll stop there. We can talk a little bit about sectors if you want, or I'm not sure what the questions are. I'm probably not a real good expert on emerging biotech, but I can give it a try.
Well, I'll start with some easier ones. I appreciate your comment regarding putting politics aside. Which sector do you expect to see the best potential for growth? And how do you feel about the percent of energy investments in a portfolio?
So I'm going to pause on the energy one because I got something at the end, and we can talk about that a little bit. What was the first question? I forgot already.
Which sector do you expect
sectors,
to
right.
see the best potential for growth?
So I don't. When I said I didn't think tech would be the market leader, I'm not disparaging this sector. I still think it'll do very well. Maybe it's the second or third best sector out there. I'm going to flip this forward. So this is kind of where we're at right now with our portfolios. We are overweight technology by about 3.5%. That goes up and down depending which way the markets go sometimes. So that can move a little bit. But right now we've had a pretty good run in technology, and we've actually trimmed that a little bit. But to answer the question, I think financials are an area that we were underweight last year at this time, and we're now overweight by not by a lot, but by about 1%. I think they benefit a lot from deregulation and pulling back some of the constraints and controls that the last administration put on them. So I think they're going to benefit. They also benefit from a expanding economy and corporate lending. So that I think there's a lot of things that they're back, and I think that's an area that's already done pretty well in the last month or so with the president. And if you have the Fed being accommodative, that tends to be good. So I think that's an area. Consumer discretionary, I still think we still like. That's the third one down. So we're a little bit overweight that one as well. So those are, we kind of position the portfolio where we think things are going. So those are some of the areas we think will do well. On the flip side of that, consumer staples, they get they've come under pressure because of the dollar rising. A lot of their earnings are overseas. The utilities, and we'll talk about energy in a second. Utilities, we've been underweight. We don't have a position there. And again, I would probably put that more in the defensive camp. So that's kind of going forward where we think things are going to be positioned. I will tell you, I always keep the right to change my mind at any point. So we'll see how it goes. And if I've learned anything over 20 some years, things move fast. But I think that's our best bet. And I do think financials will have a better than average year this year.
A follow-up tech question. Is tech moving out of California to other states going to help their earnings?
I never thought of it that way. I can't see what will hurt the earnings. Going from, I'll use Tesla as an example. They moved out of California to Texas. Their taxes are lower, obviously, so that helps. How much in the bottom line that's going to help, I'm not really sure, but I don't see it being a negative for them. And you're seeing that a lot. People moving out of the West Coast just because of the tax burden. And my guess that'll continue until there's some kind of equilibrium there. So.
And then one more philosophical question. Why do some stocks give dividends and some not? And what percent in a portfolio do you consider optimal and why? So how does that affect the portfolio construction?
So why do some pay dividends and some don't is the first question.
Correct. And then what is your thoughts on that? How do you organize that portfolio?
I don't focus too much. Well, I'll give you my philosophy second. So, that's really the capital allocation is really a decision that comes from the leadership of the company. In a broad stroke, companies that are growing tend not to pay out dividends because they can put that money to better use. So if they can reinvest that in the company and grow the company at 20%, that's a better return for the shareholders. Companies that tend to be a little slower growth are looking to attract a certain type of investor would be more focused on the dividends. I just mentioned a couple. The companies that have really high cash flow, just because it's you don't want to sit on cash in a money market or a T-bills or whatever that might be. So they tend to pay out dividends. So as far as our philosophy, when we build our portfolio, I'm somewhat agnostic to dividends. I think we're really looking at the total return. So what the stock and our total return, including dividends, is year over year. So if anything on the dividends front, I would look at more of the ones that are dividend growers. They may not have the highest dividend yield, but they continue to pay out and raise their dividend over time. So those are probably the ones we would focus more on. But as a philosophy, it's not the first thing we look at.
Thank you.
Yep. No problem. So anyway, as I said, we're committed to cyclicals at this point. We have been committed for the last year or two to be overweight those, and we still are. And as I mentioned, we do like financials as well. As far as the broader markets, we've heard this theme a lot. It's all the Mag 7 companies that are driving returns, and that's hard to dismiss. As you can see here in the upper left, the Mag 7 companies versus the S&P. Over the last, I guess, the last year, 2 years, have done pretty well. And then as a percentage of the 7 companies as a percentage of the S&P, as you can see in the lower right, continues to go. It looks like it may have peaked in that mid 30s. I do think we're going to see broadening out of the markets. I mentioned small caps earlier. Problem is that as the economy grows and the market continues to go up, the technology companies, which tend to be the innovators, are the ones growing the quickest. So it's hard to knock them out of those positions. At some point that'll happen. I can't tell you when, but I still think it's been a fairly narrow market over the last couple of years. I thought we started to broaden out late last year, and hopefully that's continuing as we go into this year. As I mentioned, if some other sectors like industrials or finance do better, then technology, you'll see a little bit of that equilibrium happen. But it's definitely a concern. It's something we watch. We do own most of the big seven names. It's hard not to. But I do think we're going to see some expansion this year. Um, you know, outside the U.S., you know, we've been overweight emerging markets recently, and we're underweight the developed markets, which is what I would consider mainly Europe, Japan, Australia, kind of your G7 countries. This is a chart that's put out every year by a guy named Michael Semblist who works at JP Morgan. In fact, he has a podcast called Eye on the Markets. If anybody's interested, you can download it for free on Apple and all the other ones out there. Kristen knows them better than I do. But he does this study, and he updates it every year, you know, on a rolling 3-year basis, using the ACWI as your benchmark, which is what we use. If you're overweight the United States and you're overweight emerging markets, or in the way he words it, underweight Europe, you tend to outperform. And there's a lot of reasons for that: growth, economic growth, birth rates, regulations, taxes. There's a lot of reasons for that, but it's something we've been keeping a close eye on, and it's worked out in our advantage, and I think we'll continue to see that going forward. So I'll pause there for a second. If there's any questions, I know there was one on energy, which I have a slide for, so we'll talk about that. Anything else?
Let's see. No, I think that's good. Oh, here we go. Hold on. Has the anticipation of higher earnings in general already been priced into the market-wide PE? If not, then why predict a correction of 10% in a pro-growth, anti-regulation environment?
So what was the first part? Has it been baked in?
Has the anticipation of higher earnings in general already been priced into the market?
So, you know, that's always a good question. You never really know what's priced in until you get there, I guess. I will tell you, I think the markets are still focused on the fourth quarter. We're going to make a shift here really quickly in the next couple of weeks to 2025 earnings. I don't think that's been baked into the market yet. It's not consensus that everybody thinks they're going to see 10%. I think some people think that could be lower, something that could be higher. It could be impacted by tariffs. So I wouldn't say it's baked in or it's, you know, already in the market. So I know that was the first question. What was the second part of it?
Yes. So then if not, if you don't think it's baked in, why predict a correction of 10% in a pro-growth, anti-regulation environment?
So that kind of goes back to does it keep you up at night? I think markets correct, and markets have corrections and consolidations all the time. It doesn't mean that the story's been broken, or the economy's, you know, needs to be fixed, or there's some type of recession on the horizon. I think, you know, and I can't tell you exactly what will cause it. I'm not sure we'll have one. I can tell you one, historically speaking, we're probably due for one. I can tell you there's a lot of things out there that I could see us tripping on, not fatal, but the market could trip on. But, you know, the old saying that, you know, if you know what the black swan event is, then it's not a black swan event because you already know it. But I think between, you know, at some point there's going to be a policy mistake, is my guess, either between the president and the tariffs being too much or not enough, or the taxes not getting passed, or the Fed, you know, doesn't raise rates and they should. I'm sorry, doesn't cut rates, and it'll show that the data said they should have, or they did cut rates and the data will say they shouldn't have. So there's all those things. But I guess the bigger point is, it's not something we're fixated on. As I said earlier, if and when it happens, we just had a 5% correction from December through early January. You know, markets bounce back. We're already at new highs as of yesterday. So again, I think some of these things you take in stride. We didn't change anything as far as our portfolios go, or you know, our outlook going into the year. But, you know, you're going to have corrections along the way, and those things just happen.
Here's a
I said it, we probably won't have one. It's probably the most likely outcome.
Here's a file. I know you're going to talk about energy, but an additional question is, with the new administration's push for energy and the demand for energy, from all of these data centers, then why underweight energy?
So, so I'm going to move on because I got a chart on that, and I think I can roll all those questions in.
Perfect. We'll do all the energy together.
Do it all at one time. So, so what we're looking at as we go forward, this is just more of an interesting fact. All years ending in 5 have the best returns. They're positive 93% of or 92% of the time, and the median returns about 26%. Not predicting 26%, but it's just an interesting fact. I wouldn't put all my eggs in one basket, but these things do tend to hold up over time. So it's just something to be aware of. As far as the composite for 2025, Ned Davis Research puts these out every year. They take the combination of the 1-year seasonal charts, the 4-year presidential chart, which I just mentioned a little bit ago, and the 10-year cycle chart, and they come up with what they think is their best guess as the composite. Again, you don't put too much emphasis on any one data point, but if you look at it again, it kind of has the same pattern. You see a fairly positive start to the markets into the summer months, some type of consolidation, and then maybe a fourth quarter rally, which historically speaking is about every year. But again, as you lay out the composite going forward, it kind of reinforces that thought. So I focus a little bit more on electricity than energy, but I think it's the same concept. President Trump mentioned, I think it was yesterday in his Davos speech, for AI to be successful, and he wants to be the AI leader of the world, we need to double the energy output or electricity output. He said energy, but he was talking about electricity. So this kind of goes back to the energy question. So I think, one of the areas we're looking at going forward, and again, you try to, as Wayne Gretzky would say, you try to figure out where the puck's going, not where the puck's at. And I think as we go forward, there's going to be this rising demand. There's a chart there from JP Morgan on the upper right, talks about data center use. So if they're going to build this Stargate complex with all these data centers, at some point you have to look at the energy or the electricity grid or the energy consumption and where does it come from. And then on the lower right, you see electrical vehicles charging. So I can remember 5 or 6 years ago, I drive into the office. I might pass one Tesla on the way in. I probably passed 30 of them on the way in now. So definitely seeing that rise, and that's another stress on the grid. So to go back to the sector question about energy, I think it's one of the areas we've been looking at. I know the president has committed to, and if you watch any of the confirmation hearings, his Treasury Secretary, Scott Bessent, or his nominee, is advocating we increase oil production by 3 million barrels a day, which would be, again, go along the way of helping on the electricity aspect of things or the energy aspect. So it's an area we're looking at. I don't know if we'll be overweight this time, next quarter, but it's something we're definitely looking at and, trying to figure out how it all plays out. I do think if we do the drill baby drill part, you're going to see much more production. I don't know if that drives oil prices down, which tends to be a leading indicator for the stocks, but that's something we're also looking at. So to answer the question, it's a good question. It's not something we've decided to do yet, but it's obviously an area we're looking at being more involved and probably having a higher weighting down the road.
Thank you.
Yep. And last thing, I talked about private markets for a little bit. There's a lot of data and demand out there for private markets. And if you look at how many stocks are on the New York Stock Exchange, the number of public stocks keep coming down, and companies are staying private longer. But the only caveat I put out there, or concern, is you have to really choose wisely on these. So this is a chart that JP Morgan puts out every year in their guide to the markets, and it shows basically dispersion. Over the far left, you're seeing global large cap equities. So that's like the 75th percentile is the top and the 25th. So, the top quarter and the bottom quarter basically, and what the range is. And it's fairly tight, from 9.7 to 7.8. You see the same thing with bonds. But then as you go to the right of the chart and you see some of the more private markets, you definitely see a wider dispersion. So, not all managers are equal. And, so we have a partnership with Hightower, as everybody knows, and they have a group, their alternative investment solutions group in New York that does a lot of due diligence, is what I would call it, on these names, and really does help us pick what we think are the best offerings for our clients. So if you have any thoughts about it, I would suggest you talk to your advisor. We'd be happy to get more involved in it, or take a deeper dive with you. But I think you want to wade into the water carefully, and you want someone helping you with that selection process. And I think that's it, Kristen. I know I asked for questions, but we already took a bunch, more than we normally do, which is great. But
yes, there are a lot of questions today. There's a couple very specific biomedical kind of questions that I'm going to send to you separately.
Okay.
Another question is, besides the Mag 7 companies, how much weight do you put in the next 8 to 15 companies?
Well, the next 8 to 15 companies are still pretty big companies. In fact, if they're probably not worth $1 trillion, but they're pretty close. They're not small. So yeah, I would put a lot of weight into those.
And then this is just so I can say this. Will you be considering the reality that the Trump policy of drill, baby, drill will not mean producers will spend the capital to do so?
Well, that's a great question, because that's been brought up before. You can open them up for drilling, but if, there's the old saying, if you poke a hole in the ground and it costs you $80 to get the oil out, but oil is only trading at 70, then why do it? And I don't know the cost structure well enough to say what areas are better. I know some areas are cheaper to drill than others within the U.S. and I'm sure overseas as well. And then it becomes, is it sweet oil or sweet crude or sour crude, which is another issue because it costs more to refine. So, there's a lot to be worked out there. But I do think, companies are, you create a company to drill oil. And I think if it's in their financial interest to do that, they're going to do it. But it's a good point. It doesn't mean that just because they open up an area that it's economically feasible to do it. So, anything else?
I think that's it. Thank you everyone for all the questions today. Thanks, John. Like I said, if we aren't able to get to your question, I do have a couple that I'm going to bunch and send to John directly. The investment team and/or your advisor will reach out directly. Thanks for joining us today. It's our privilege to inspire you and your family, and we feel sincere gratitude for your trust and loyalty. Stay warm out there.